Nobody talks about the real price of speed in real estate. But what if that quick bridge loan is quietly eating your entire profit margin alive? We're not talking about a rounding error. We're talking about thousands, sometimes tens of thousands of dollars vanishing before you ever swing a hammer. Hard money moves fast, and that's the whole pitch. When a motivated seller needs to close in 10 days, conventional financing laughs at you and walks out the room. But speed, like everything worth having, comes with a price tag that the lender buries in the fine print like a confession note under a couch cushion. Let's actually do the math that nobody does before they sign. Because the sticker rate, say 12% annually, sounds almost reasonable until you remember that hard money isn't really annual, it's monthly compounding with fees stacked on top of fees. You're not borrowing money, you're renting it from someone who knows you're desperate and priced accordingly. The origination points alone, typically 2 to 4% of the loan amount, hit you at closing before you've bought a single box of drywall screws. On a $300,000 loan, that's $6,000 to $12,000 gone on day one, before the interest clock even starts ticking. Now layer in the monthly interest. And here's where the psychology gets dangerous, because 12% annually sounds like 1% a month, which sounds almost cute. 6 months of that 1% on $300,000 is $18,000. And suddenly your affordable bridge loan has already cost you $25,000 to $30,000 before renovation even begins. But wait, we're just getting started. Because hard money lenders also love extension fees, draw fees, inspection fees, and the occasional "we feel like it" administrative charge that shows up on your settlement statement like an uninvited house guest. The industry joke is that the only thing harder than hard money is finding all the fees they reproduce when you're not looking. Historically, investors in the 1980s and 90s learned this lesson on the brutal way during the savings and loan crisis, when short-term private lending exploded and then imploded, taking over-leveraged flippers down with it. The survivors weren't the boldest, they were the ones who modeled the all-in cost before they ever made an offer, not after. Here's the misconception that kills new investors. They compare the hard money rate to a 30-year mortgage rate and feel ripped off, but that's the wrong comparison entirely. The right comparison is the cost of losing the deal, losing the assignment, or watching another buyer close while you're waiting on a bank's 45-day underwriting process. So the real question isn't whether hard money is expensive, it obviously is. It's whether the deal still pencils after you've honestly accounted for every dollar the lender will extract from you. If your projected profit is $40,000 and your total borrowing cost is $32,000, you are not flipping a house. You are working a very stressful part-time job with unlimited liability. The practical discipline here is what separates the investors still in the game after 5 years from the ones selling courses about why they quit. You must underwrite the loan cost as a hard line item, not an afterthought. Model your points, your monthly interest, your expected hold time plus a 2-month buffer, and every fee in the term sheet, and if the deal doesn't survive that stress test, the deal doesn't survive. There's something almost poetic about hard money. It was designed to fund opportunity, but it punishes hesitation and rewards precision like almost nothing else in this business. The lender doesn't care if the market shifts or your contractor ghosts you. That meter is running at the same rate whether you're making progress or eating cereal in a half-demoed kitchen wondering what happened. Community wisdom from experienced operators consistently echoes the same refrain. Your exit strategy must be locked before your entry, not figured out somewhere in the middle. Whether you're refining into a DSCR loan, listing on the MLS, or wholesaling out of the deal, that exit timeline directly determines your true cost of capital. At the philosophical level, this business rewards the boring discipline of knowing your numbers cold over the exciting conviction of, I just have a good feeling about this one. Sizing your loan correctly, borrowing only what you need, and negotiating even 1 point off origination can mean the difference between a deal that built wealth and a deal that built experience. The beautiful irony is that the investors who respect hard money's cost the most are the ones who use it most effectively, not avoiding it out of fear, but deploying it surgically with full awareness of every dollar it costs them. Being comfortable with either outcome closing the deal or walking away is itself the competitive advantage that keeps you rational when everyone else is emotional. And if you're ready to run those numbers for real, on a real deal, with real lenders and real contractors by your side, check out our links in the description below. We can help you get started in real estate investing, connect you with hard money and conventional lenders, and match you with trusted home contracting professionals.